Good morning, dear learners, and welcome you all to the next lecture of my course on financial literacy. I, Dr. Vandana Sonkar, Assistant Professor, Faculty of Commerce, welcome you all to this module where we are discussing about the trading mechanisms in the stock market. And in this lecture 57, we are going to discuss about one of the very important and interesting topic of the stock market, that is the options trading. Here we are going to discuss one of the very important tool of hedging of the risk, that is the derivative, and in the derivative we are going to discuss one of the type, that is the options. So here we will be going to discuss about the various types of options and the strategies of investments related with the option trading that can help you to minimize the risk related with your investment, and it can give you a high potential of maximizing of your wealth. So in this lecture we will be going to discuss the concept of options and the various types of options, that are the call and put options. We will be going to discuss the various positions related with the long call and put option, that is the long call option and the short call option, and the advantages of these options trading in the stock market. And we will be also going to understand what is the difference between the options and the future contracts of derivatives into the stock exchanges. So let us start the discussion by understanding the meaning or the conceptual part related with the option trading. So as we all know that derivative is a tool or financial contract that helps both the parties involved into the contract to minimize the risk as well as make their earning potential more confirmed. So this particular kind of option or the derivative contract basically is a contract that gives the buyer of the contract a right but do not gives any obligation to perform in the contract. So they need to pay an option premium for the purpose of purchasing this particular right and having no obligation in the contract. Basically, the Indian financial market encompasses a variety of the asset classes, that may be equities, fixed income securities and commodities, and for trading into all these types of assets we can create derivative contract to minimize the risk involved in the trading of all these financial instruments. So derivatives basically have gained a significant popularity among the Indian as well as the global traders because of their characteristics of providing the minimization of risk with the help of the derivative arrangements. So basically, derivative in the option trading is a key segment, and options are the financial contracts that provide the purchaser with the right, though not the obligation, to sell or purchase a specific asset at a pre-agreed price within the certain time frame. That means the purchaser of the option contract may have a right to sell or purchase a particular underlying asset under the contract without any obligation at a predefined price at a particular point of time, that is the maturity time of the derivative contract. So that is known as the price within the certain time frame. So the value of option of the derivative is linked to basically the underlying asset, that can be equities, fixed income securities, commodities, or any other kind of the financial instrument that is traded into the stock market. So these underlying assets may define the prices of the option contract that can range from the shares, bonds, commodities and other tradable financial instrument as we have discussed. Basically, unlike the future contracts, in case of the options, the obligation is not on the part of the purchaser of the contract. So that mandates the fulfillment of the agreement, and option may offer a greater flexibility as they do not compel the holder to execute the contract. Then that means the execution of the contract is not compulsory, and if the market conditions conditions are favorable, then only the right that is given to the purchaser of the option contract is exercised, and the execution of the option contract is traded. In unfavorable conditions, the holder may not execute their order, and the expiration of the contract will take place in case of the option trading. Now, the various types of options are the call option and put option. The call option is a kind of derivative contract that gives the buyer a right but not the obligation to buy a specific asset at a fixed price, that is known as the strike price, before a certain date. So, people basically use the call option or buy the call option when they expect that the prices of the asset in the market may go up. That means if there is a increasing trend of the prices of the asset in the market, they can take the call option, the buy position, and if the prices are rising, they can get profit by either selling the option or buying the asset at the lower stock prices with the help of the call option trading. Then comes the put option. A put option gives the buyer the right to sell but not the obligation related with the sale of the specific asset at a fixed price before a certain date. That means in case of put option we get right to sell, and in case of the option we get right to buy the asset at a predetermined price before a certain date. So, when the investors go for the put option, they believe that the prices of the asset in the market will fall. So, on the basis of that, on the basis of the predictions related with the drop of the prices of the asset, they can either sell the option for a profit or they can sell the asset at the higher strike price that has been decided under the put option contract before the maturity of the contract. So, these are the two types of option, that is in one case we can get the right to buy, and in one case we can get the right to sell the asset at a fixed price before the maturity of the contract. Now, let us understand in detail what we mean by the call option. So, call option is a financial agreement that gives the buyer the right but not the obligation to buy certain amount or quantity of the underlying asset at a fixed price, that is known as the strike price, before a deadline, that is called the expiration date of the option contract. So, investors basically they tend to purchase the call option when they believe that the prices of the asset will increase in the market. So, the key terms that are related with the call option is that it is a right, not the requirement. So, you have the right, but there is no necessity that you need to exercise this right under the contract. Then there is another concept, that is the strike price. Basically, strike price is the agreed upon price at which the underlying asset is traded under the call option. So, this is the price that is negotiated between the two parties under the call option contract. Now, the expiration date is the next concept. This is the time period by which you need to use your right of purchasing that asset under the contract. So, the option, the contract that you have purchased, this must be used before the expiration date. After this, the option becomes invalid and you will not be able to purchase the asset at the strike price that you have negotiated under the contract. Then comes the underlying asset. This refers to the various types of assets that will be purchased under the contract. So, this may be a stock, an index, a commodity or a currency, depending on the need of the two parties who are involved into the contract. And then comes the premium. To acquire the right under the option contract, you need to pay a price which is known as the option premium. So, basically the buyer pays an upfront cost which is known as the option premium, and this is the price of the option itself in case of the options derivative. Now, let us understand the different positions related with the call option. The first position is long call option. A long call option is basically a popular strategy that is used by the investors who expect that the prices of the specific asset such as the commodities, stocks or currency may rise significantly above the certain level before the date of the expiration of the option contract. So, they take a long position. By using this strategy, the investor can buy a call option and they can pay an option premium or upfront cost and may have a right to purchase the asset at the strike prices, whether the prices in the real market may increase above the strike prices in that case also. So, they have a right to purchase the asset at the strike price within the specified time of the option contract, and whether the actual prices may be increasing more than the strike price, that will also not impact the prices under the long position of the option contract. Now, this approach is typically used when the investor expect that there is a bullish market on the stock exchanges and they anticipate that the prices will increase beyond the strike prices that they have negotiated under the contract, and this can lead to potential profit for the purchaser, that is person who is taking the long position in call option. And however, if the asset prices stay below the strike price, the option premium may become worthless for the purchaser of the call option, and the investor may lose the option premium paid for purchasing the call option. So, the minimum loss in such case to the purchaser of the call option will be the upfront cost or the option premium paid to the seller of the contract. Now, the next position is the short call option, which is just the opposite of the long call option. So, basically a short call option is a trading strategy where the investor sells a call option without owning the underlying asset. So, they do not actually purchase the asset from the market for selling the asset under the contract. Without owning the asset, they take a position where they take a right to sell the asset under the contract. So, by doing so, the seller agrees to deliver the asset at a fixed price if the buyer decides to exercise the right given to them before the option contract expires. So, this approach is used when the investors believes that the prices of the underlying asset may stay same or they can decline in the market to a slight level, to a little bit level. So, that means if the asset remains below the strike price, the option is likely to expire in such case. That means the right of the purchasing of the asset will not be used and the seller will need not to purchase the asset from the market and deliver it to the next party, and the seller gets to keep the premium received. That means it is the potential profit that they can keep, and when selling the option, then the maximum possible profit will be there to the short call to the holder of the option contract. Now, risk related with this strategy is very high. If the asset prices rises significantly in the market above the strike price, the seller may need to purchase that asset at the above than the strike price from the current market, and they need to sell it to the option holder at a lower strike price. So, this can lead to potential huge losses to the holder of the short call option. The short call position basically used to generate immediate income for the option holders. So, the premium is the immediate income that can help to cover the margin requirement in the stock market for offsetting the other position. So, they carry a high level of risk if the market moves against the expectation of the traders. Now, let us understand the short call position in detail. Basically, this strategy is used when the trader expects that the prices will remain same or it will decline in the stock market. If the prices stay below the strike prices, then the option will expire. That means it will be remain unused, and in such cases the seller will have the profit of the option premium that he will get from the option holder in the contract from the sale. This premium basically represents the maximum potential benefit for the holder of the short call option. Now, if the asset prices rises above the strike price that is negotiated between the two parties, the seller could face significant losses in the contract, and they may be required to purchase the asset at higher market prices, that is above the strike prices of the contract, and they may lead to potentially posing unlimited risk under the contract on the holder of the short call position. Now, the next type, that is the, we have discussed that two different types of the option contracts are there, call option and put option. So, now let us discuss the next type of the option contract, that is the put option. What do we mean by the put option? Basically, it is a type of the financial contract that gives buyer the right but not the obligation to sell a specific quantity of an underlying asset at a specified price within the maturity time of the asset, that is the before the expiration date. So, here the right that the holder has is the right to sell, but they do not have any obligation. For example, let us understand, suppose that if the stock prices in the market of a stock is 600 and the various other details such as the stock strike price under the contract is 570 and the premium that you need to pay is 15 rupees and expiry for the 1 month period, then under this scenario the stock prices, if they fall below the strike price, suppose that 530 rupees, and you sell it at 570, that is the strike price that has been negotiated under the contract, then in such case you can have a profit of 570 rupees, that is the actual strike price that you have negotiated less the actual price of the stock, that is the below the stock price 530 rupees and the option premium that you have paid. Then also you have a profit of 25 rupees under the put option contract if you take a position of the holder of the put option contract. Now, let us understand the example more clearly. Suppose that if the stock prices are above the strike price, the next case, in the previous example the prices were below the strike price. Now, suppose that if it is above the strike price, in such cases the option will become worthless for the holder of the contract, and the maximum loss in such case to the holder of the contract will be the option premium, that is the 15 rupees. Suppose that if it is equal, that means the stock price, strike price and the current market price of the underlying asset both are 570 rupees, then the break even on the exercise price will be there. Again the loss, maximum loss will be the option premium paid by the holder of the contract. Now, a put option gives the holder the right but not the obligation, that we need to remember, to sell the underlying asset, that is the underlying asset at the strike price of 570 in such case, regardless the price fluctuations of the asset, that means the 530 or 590, whatever is the price, the selling of the asset will be take place at 570 rupees only. So, if the market prices drops or it rises, it doesn't have an impact on the strike prices of the option contract, and the option holder may have a profit of the in case of the prices of the asset goes down, or they may have a maximum loss of option premium if the prices moves up of the underlying stock in the market. Now, the various advantages of the put options are, it helps you to protect the risk involved in the trading in the stock market due to the price fluctuations of the underlying assets. It helps to have the benefit of leverage, that means it gives you an exposure to larger position with a relatively small investment, that means only option premium is the maximum loss. You need to only pay the option premium, and that can offer you the potential for substantial returns in the option market. It gives you an income opportunity of higher volume. That means upfront cost is less, but upfront by selling put option may be higher as compared to the other financial instrument available in the stock market. It gives you strategic flexibility. That means it allows you to wide ranging of the trading of the securities and trading strategies in the stock market. So from speculative bets to the protective hedges, you can have the advanced strategies with the help of trading into the put options and call options of the derivative. Now let us understand in which conditions the traders can sell a put option in the market. When they had an obligation to buy. That means when you sell a put option, you agree to purchase the underlying asset at the strike price if the option is exercised by the buyer. That means if you have any obligation to buy, you need to sell a put option. Then if you are having losses when the stock prices are dropping into the stock market. So if the stock prices are falling down, the seller may face a loss because they are forced to buy the stock at the higher prices while the market value of the stocks are lower. So in these two conditions, we need to sell a put option, as well as when profits when the stock prices are rising. So if the stock prices are rising and stay above the strike price, the option is not exercised, and in this case also the seller can keep the premium as a profit of the particular contract. Then next is strategy. Sellers typically write put option on the stocks when they believe that they will hold in the particular contract if there will be any increase in value of the underlying asset in the market. So they rely on collecting the option premium from multiple contracts for the purpose of offsetting the potential losses of the other options contract in the market. So these may be the various cases where we need to sell the put options. Now the next part is the difference between the put options and the future contract. The future contracts are also a category of the derivative instrument that helps you to minimize the risk involved into the financial segment. Now let us understand the difference between these two types of derivative. The meaning of the option contract is that it allows the buyer to have the right, but it do not gives any obligation. So the buyer choose whether or not they want to buy or sell the underlying asset under the contract at a specified price before the maturity of the contract. So they only need to pay a premium to the next party, and they can have a right of either buying or selling the underlying asset at the strike price that has been negotiated under the contract. Whereas the future contracts is a binding agreement. That means it gives you both the right and the obligation under the contract between the two parties to buy or sell the asset at a predetermined price at a future date. That means both the parties must fulfill the terms and conditions under the contract when it reaches its expiration. So in the future contract, the holder of the future derivative contracts have both the right that they need to exercise under the contract. Next is on the basis of obligation. If we compare the two types of contract, the options has the right but not the obligation, whereas in case of the future contract, both the buyer and sellers are bound by the terms and conditions under the contract. That means they must need to carry the transactions on the agreed date. The buyer must purchase as well as the seller must sell the asset under the future derivative contract. On the basis of risk, if we compare the two types of contracts, options, in case of the option, the maximum risk that is posed to the investor is the loss of option premium. That means the risk for the buyer is limited to the premium paid for the option only, whereas in case of the future contract, both the buyer and seller, they face unlimited risk. So if the prices of the asset moves unfavorably, both the parties may incur significant losses with no upper limit to the potential losses under the future derivative contract. Now, on the basis of cost, if we compare both the contracts, options are the contract that may involve the upfront cost, which is known as the option premium. There are various theories of the calculation of the option premium. So, the maximum price that we need to pay in case of the option contract is the upfront cost, that is the premium that may represent the maximum amount of loss that we may have under the option contract. Whereas in case of future contracts, there is no upfront cost. That means both the parties only need to deposit the margin as a guarantee to cover the future potential losses under the contract. The margin is not a cost, but it is a kind of performance bond that is given to the clearing houses for the purpose of offsetting the losses and the profits under the future derivative agreement. Now, the next one is the on the basis of purpose. If on the basis of purpose we categorize both the types of contract, options are used for speculation or hedging, that is the minimization of risk that may be there due to the fluctuation of the prices of the underlying asset under the contract. Whereas futures are used for hedgings or speculative purposes both. So, business or the corporates may use futures to lock in the prices of the underlying asset for their future transactions. So, while trader may use them to make the profits when the market prices of the asset may change. So, these are the difference between the option and the future on the basis of purpose. Next is on the basis of settlement of the trade. If we talk about option, the options contract can be exercised when the buyer purchases or the sell the asset under the contract, and if they left to expire with the contract without any action, in such cases the option need not to be settled. So, many options are cash settled, meaning no physical asset is exchanged under the option contract due to their different distinguished characteristics. Now, the next one is the future. Future contracts are basically settled by the physical delivery of the asset or through the cash settlement, depending on the terms and condition as are negotiated between the different parties under the contract. The next basis of difference between the option and the future is the flexibility. So, options offer more flexibility because the buyer is not compelled to use the right that is provided to them under the contract. So, the maximum risk is only the premium paid under the case of the option. So, it gives you better flexibility to trade into the stock market, whereas futures are less flexible because both the parties must fulfill their rights and their obligation under the contract. So, profit and loss depends directly on the basis of asset price movement under the future derivative contract. The next difference is expiration. On the basis of expiration, the options have a set expiration date. The buyer can exercise the right given to them until the expiration date of the option contract. If they leave their right, then it becomes worthless. Whereas in case of future contracts, the future contracts also have a expiration date and both the parties are obligated to execute the trade when the expiration date arrives. So, futures are typically closed before the expiration through offsetting of the trades. So, these are the various details related with the two different categories of the derivative contract, that is the options and futures. Now, with the help of all these concepts, you can very easily speculate and you can hedge the risk involved due to the price movements of financial securities and different type of assets in the financial segment. So, with this, I come to an end of this lecture. Thank you.